Hello everybody, my name is Lewis Gudgeon. I'm a PhD candidate at Imperial College London. I'm going to present today the Decentralized Financial Crisis, which is a paper joint work with Daniel Perez, Dominic Hart, Benjamin Lifshitz and Arthur Gervais. So I'm going to structure this talk as follows. Firstly, I'm going to talk about what DeFi is, and what our motivation is. I'm then going to talk about the approach we take to the economic stress testing in DeFi. And then finally, I'm going to present the two attacks that we develop on Maker's governance mechanism. Maker is one particular lending protocol. Okay, well, so let's start with what DeFi actually is. This is the definition that we provide in the paper. DeFi is a peer-to-peer financial system which leverages distributed ledger-based smart contracts to ensure its integrity and security. So if you want a rough heuristic, what you can think of is that DeFi is essentially you take blockchains, you take traditional finance, you clap them together and you get something that is a little like DeFi. DeFi is something that is alleged to have very significant promise. Here are a number of headlines, many of which very enthusiastic. Is DeFi the future of finance? DeFi will eat traditional finance and dramatically expand the global lending market. What we can see from headlines like this is that at present DeFi is something which is really gathering a significant amount of interest and indeed is something to be excited about. And if we look at the total value locked in DeFi projects, we can see how that has evolved over the last year or so. So this is using data from DeFi Pulse, and we can see that the amount of locked dollars in DeFi projects has grown fairly steadily, touching over $1 billion earlier on this year, and now as of the time of doing this presentation, it's again at just around $1 billion. So DeFi is something that has been growing, but of course also, as this figure shows, there has been some volatility in its growth. So why should we be interested, or what is there to be excited about here? So DeFi offers some potential advantages over traditional finance. For instance, it may reduce the requirement for financial intermediaries, such as banks, to operate in the financial system. We have to remember that one of the original motivations for Bitcoin was, as a result of the financial crisis in 2008, was to recast the role for banks and develop a financial system that didn't require such intermediaries. So that's one potential application of DeFi. Another use of DeFi is the provision for financial services for low-income individuals and also the unbanked. So from the more humanitarian perspective, this of course also offers very significant advantages. But too, there are other risks there which we should be mindful of, particularly related to equity and fairness. And thirdly, something that is potentially very exciting is the possibility for DeFi to allow technology to provide a more robust financial system where single points of failure in an economy are either eliminated or the potential impact of such points existing is mitigated. So what was our motivation in writing this paper? Well, the title, A Decentralized Financial Crisis, is quite loaded. And what our main observation is that 10 years after the inception of blockchains, a complex financial architecture is emerging on top of them. But as this architecture develops, it is at risk of the very sort of financial meltdown it is supposed to be preventing. So we hope that this paper can serve to guide developers, researchers, in thinking about some of the risks that are relevant when dealing with DeFi economic systems. There are several types of DeFi protocols for lending, decentralized exchange, derivatives, payments. What we focus on here are the protocols only for lending. Now that's because, as you can see on this slide, DeFi protocols for lending constitute about 80% of the market in terms of locked funds. So in the paper, we do three main things. Firstly, we provide some economic stress testing, which we develop with a stylized example. Secondly, we provide a formalization of DeFi lending protocols more generally. So this is a mathematical formalization of the constraints on the economic security of these protocols. And thirdly, we present two distinct attack strategies on the governance mechanism of one protocol in particular, which is Maker. So today in this talk, I'm going to focus just on 1 and 3 here. Okay, so let's start with the economic stress testing. So for economic stress testing, the starting observation is that, let's look at the history of the world economy. And here, this plot is using data from the World Bank, and it's plotting annual world GDP growth. And what you can observe is that there are periods of GDP growth that are become significantly lower than before in terms of percentage terms, and also can become negative. So notably here, 2009, we see negative GDP growth. What this means is that, just looking at what has happened in the past, economic downturns are potentially an inexorable feature of the world economy. And the question becomes, therefore, in the event of such economic downturns, how will DeFi lending protocols fare? So we develop a stress testing framework. What we do is we create a stylized DeFi lending protocol. So this is one that resembles the largest DeFi lending protocols. And crucially, what these share is that the economic security of these protocols depends critically on their over-collateralization. So whether sufficient collateral margins are present, which allows the economic security of these protocols to be to some extent assured. Whether those margins obtained depends on the market liquidity. So what that means exactly, I'll come to in a moment. But the main point is that for these lending protocols, the main state that they need to avoid, at least with current designs, is under-collateralization. So with under-collateralization, it means that the sum of all capital that is used to back debt is lower than the value of the debt. And in that situation, given an assumption that agents are economically rational, we assume that they will just renege on their debt commitments. So these are the main assumptions that we make in our framework. So firstly, we're assuming that we have some lending protocol that allows users to borrow units of debt against collateral. And we assume here that the collateral is ETH. So we take historical price data on ETH. We then assume that the protocol has a store of some reserve asset, which is just a generic reserve asset. But we say that this is half as volatile as the collateral asset. Then what we say is that at the start of a price crash, the system immediately tries to liquidate all of the collateral it has to cover its debts. So at the start of the crash, the protocol is collateralized to just about its minimum required level. So if it has a collateralization ratio requirement of 150%, at the start of the crash, it is collateralized to just over 150%. Okay, so in this slide, you can see the simulated price movements of ETH and of our reserve asset. So we do 5,000 simulations. These are Monte Carlo simulations using geometric Brownian motion. And you can see for these 5,000 different price paths, how the price paths evolve. So you can see that there is a relatively wide range of outcomes precipitate by the end of the 100 time step, so day window that we're looking at. Okay, so what we do is we consider a number of cases where each case uses a different degree of correlation between the collateral asset and the reserve asset. So the first case we consider is where the collateral asset and the reserve asset are strongly positively correlated. So that's what we see here. So in the event of strong positive correlation between the two assets, when the price of ETH falls very significantly, the price of the reserve asset would also be expected to fall significantly. So that is what this figure shows. These price paths are in some sense similar. In that event, this figure shows the evolution of the collateral margin in one of these DeFi lending protocols. So what this figure is showing, going from left to right, is the amount of debt increasing from $100 to $400 million. In the $100 million case, so this is all the way across on the left, we can see that at this, the crash starts, but what happens is agents are able to, or the protocol rather, is able to liquidate its collateral quickly enough or in time. So the solid line is showing the margin of over-collateralization, and the dashed line is showing the amount of debt that remains in the protocol. We can see that as we increase the debt amount to $200 million, the margin becomes lower, and nonetheless, though, the protocol is able to liquidate all of its debt in time. However, by the time we get to the fourth panel with $400 million, what we see is that the margin at 19 days does actually become negative. So what's happened there is, despite the protocol attempting to liquidate its debt as quickly as it can, the margin becomes negative and enters this red zone on this graph. So if that was to happen, this would be under-collateralization materializing. And we assume that at this point, agents who are economically rational would just renege on their debt commitments. So that was the case where we had a strong positive correlation between the collateral asset and the reserve asset. What if instead the correlation was positive but weaker? So that's what we consider here. So here you can see the price evolution of these two different assets. And here you can see the impact that that has on the collateral margin. So the main takeaway here is that by using a reserve asset that is less tightly correlated to the collateral asset, we actually have a ability to prevent the crisis from materializing. So whereas before with $400 million, the margin became negative at 19 days, now the margin is actually able to just about remain positive. Finally, we consider the case where you have a reserve asset that is actually negatively correlated to the collateral asset. So what we're addressing here is the question, if you were able to access an asset which was negatively correlated to the collateral asset, what might that do to the economic security of your protocol? And here we can see that indeed it does, having an asset which is negatively correlated does seem to boost the health and the economic resilience of the collateral margin in comparison to the previous case, and in particular the case where the reserve asset and the collateral asset were strongly positively correlated. So here you can see that the margin it does not, even by within 100 days and with a debt of $400 million, the margin does not become negative. So overall, to summarize here, what we've shown is that by using different combinations of reserve assets and collateral assets, it may actually be possible to prevent or help to prevent financial crises, where that means crises of undercollateralization in these lending protocols. And finally, this heat map shows why the initial liquidity that is available for the liquidator matters. So we have, for different ranges of debt, from $400 to $750 million, we show the impact of different extents of ETH liquidity. So in a sense, how quickly you can sell your collateral asset. We show the impact that that has on the speed to crisis, shown with the bar on the right-hand side. So what we can see here is that as the level of debt increases down to $750 million, and as the ETH liquidity shrinks from $45,000 down to $5,000 and zero, crisis will precipitate more quickly because you're just, as a protocol, not able to liquidate your collateral in time. Okay, so that wraps up the economic stress testing component, and now I'm going to talk about the set of governance mechanism attack strategies that we consider on Maker. Okay, so we're now looking at one specific protocol, Maker, and what we're looking at is the governance mechanism that is in operation there. So what is a governance mechanism? So in Maker, the governance mechanism allows a set of stakeholders to reach a decision on changes to its organization and to its system. And in Maker, this mechanism is done via a voting mechanism. So holders of the MKR token can vote on proposed changes by staking their MKR in these proposed changes, and they can therefore elect a new contract as an executive contract. The point is that if you have enough MKR token, you're actually able to change system parameters. Now, more to the point, if you're able to change these system parameters by staking MKR token, if a malicious contract can be elected as executive, then firstly, the contract would be able to transfer all the ETH collateral to the adversary's address. And secondly, the malicious contract would also be able to mint new DAI tokens and transfer them to the adversary as well. So this attack was first proposed by Mika Zoltu, and what we do in this work is we show the feasibility of this attack through two distinct attack strategies. So let's have a look at how the amount of MKR token has evolved that is staked on different executive contracts. So you can see that a couple of things emerge from this figure. So firstly, the amount of MKR that is staked on these executive contracts is relatively volatile. Secondly, you can see that just after Mika Zoltu published his blog post, the amount of MKR staked rose very sharply to 160,000. So perhaps in response to the post. So what we consider are two distinct strategies that allow an attacker to acquire enough MKR to undertake the attack. The first strategy is called crowdfunding, and the second is called flash loans, or using flash loans. So in the crowdfunding strategy, the idea here is that rather than a single attacker attempting to amass enough MKR to elect a malicious contract as executive, they can crowdfund the required capital. So a contract is programmed that says once enough MKR has been raised within this contract for the attack to take place, then let's stake these funds on a malicious executive contract, and we can drain the collateral and we can profit from this. So at the time that we first explored this, we found that the attacker would be able to make, or the collection of attackers would be able to make about $263 million US. So this is a significantly profitable attack. And more than that, this attack strategy was not just a hypothetical concern. So here is an admittedly informal poll conducted on Twitter by Dean Eigenmann, and he says, essentially, would you be interested in carrying out such a crowdfunded attack on Maker? And about 46% of respondents said they would be. So this is a real concern at the time. So the second governance mechanism attack strategy that we look at involves flash loans. So here, flash loans are a way that an agent can go to a protocol and they can borrow liquidity without requiring any collateral to be posted. So the main requirement of these flash loans is that the loan is repaid within a single transaction. So provided an agent is able to repay the loan within a single transaction, they can borrow as much as they like. So what we do here is we say, rather than the user requiring to crowdfund the liquidity to undertake the attack, instead the user can simply get the liquidity from via flash loans. So how does this attack work? So the first thing that has to be done is the attacker deploys a malicious governance contract and also deploys an attack contract which will execute the flash loan. So that's in the first transaction. In the second transaction, what the attacker does is it calls the attack contract that was previously deployed, and then it does the following. So firstly, it takes out a flash loan. So for instance, on Aave or DYDX, which are other protocols which allow for flash loans. And what you do there is you try to borrow as much currency in a pair that will allow you to buy as much MKR token as possible. So at the time that we wrote this, 7th of February, that was ETH. Then once you have borrowed your ETH with a flash loan, you then sell this ETH for MKR on some type of decentralized exchange. Then you, with this newly acquired MKR, you use this to vote. You use these tokens and you say, let's replace the governance contract that was in place and replace it with our malicious one, which we deployed in the first transaction. Then once you have your malicious transaction in place, you're able to withdraw the collateral from the system, and you're also able to mint yourself as much DAIs as you like. So when we first wrote about this attack, again, we found this could be significantly profitable. Assuming there is enough liquidity available, the profit would be the order of 191 million US dollars. Okay, well, so with these attack strategies, we of course reached out to Maker to explain our findings regarding the feasibility of these attacks and just to make them aware. So on the 7th of February, we reached out and we said that we have performed an exposition of the attack and we believe it's feasible. 14th of February, we had a call with members of the Maker team. They were very willing to engage, and we agreed to send them our work prior to publication. We then did that a few days later. Then on the 18th of February, we contacted the Maker team again, and we warned them that with the flash loan strategy, the risk of the governance mechanism attack was now higher because you didn't rely on this crowdfunding approach. And then on the 21st of February, Maker announced that the governance security module had been activated with a delay period of 24 hours, which does serve to mitigate this attack. So that's about all I want to say. I'm very happy to take some questions. Thank you.